Hello. Good evening. Sorry for starting the class super late. My name is Michael. If you can hear me, you can just drop a comment on the section chat box.
We can hear you, sir.
Oh, perfect. Good evening, everyone. Hope you had a nice day. So once again, I apologize for that we are starting the class super late because of due to some logistics. I also want to believe you can see my screen. So today we'll be looking at journals and ledger and financial accounting for May diet. So, okay. Good evening, Patricia Obas. So let's start. What do we understand by ledger and what do we understand by journal? In general overview of ledger is a recording used that sorts and summarizes business transactions. In ledger is used to record transaction using debit or credit. As you all know what debit and credit is, debit is always the account that usually receive amount, and credit is always the side of the account that I usually give out. They are equal but opposite entries. So they are equals in terms of the format, but they actually have opposite entry. So for every transaction, you should know that when one is giving out, the other is actually going to be receiving. For every transaction that exists, there's always two parties involved: the person that is giving and the person that is receiving. Likewise, the person that is making sales and the person that is buying. So for every one transaction, you should know that there's always two parties involved. There are main 5 types of accounts when it comes to general ledger. And these accounts are assets, liability, equity, revenue or income, and expenses. Assets, assets and expenses are always the debit entry accounting, while liability, equity, and income are always credit balancing accounting. So most of the time when you are having assets or you are having a transaction with an expense, your entry is most likely going to be on the debit side. And most of the time, if you're having a transaction on liability, equity, and or revenue, your transaction is most likely going to be on credit side. I'm just trying to simplify this explanation in a layman so you can easily understand faster and better. Each type of account have various sub-accounts itself. Within them, for example, we have assets. And what are the examples of assets? They include savings, checking accounts, savings or checking accounts. So what does that mean is that assets has a several type of examples. For example, you can have your cash account, you can have your bank account, you can have your inventory, you can have even your, what do they call it now, your furniture and fittings account, your plants and equipment accounts, your land and building, and so on and so forth. They are all examples of assets. Asset, however, is divided into two. There are non-current assets and current assets. So non-current assets are actually assets that can last for more than a year, while current assets are assets that last within a year. For example, an example of a non-current asset is, what do they call it? Furniture and fitting, property, land and property, plant and equipment, land and building, and so on and so forth. And why current assets are actually assets that that can last within a year. For example, your cash, your debtors, your prepayments, and so on and so forth, your inventories, and so on and so forth. We will see it when we cruise down during the explanation later. To post to general ledger, you must use double entry bookkeeping. I know that if you don't know the golden rules of accounting, here is the golden rules of an accounting for you. That for every debit entry, there is always a corresponding credit entry, and for every credit entry, there's always a corresponding debit entry. What does this tell us is that, like I earlier explained, that a transaction is always involving two people, two sides of it. So the one is the receiving side and the other one is the giving out side. So the one is on the receiving side is the debit and the other one is in the credit. So you need to understand that for a transaction to take place, there must be two different accounts where you are posting into. And for your transaction to be able to complete, there must be two accounts that you are posting into. Note, one is the debit side and the other one is the credit side. Like you said, with the double entry bookkeeping, you record two entries for every transaction using the debit and the credit. Your general ledger provides the necessary information to create financial statements like your business balance sheet, your cash flow statement, your income statement, and in turn, your financial statement can give you a clear snapshot of your business finance. You should understand that the Bible says that if the foundation is spoiled, what can the righteous do? So if your general ledger or your journal entries is poor, is bad. There's no point why you are preparing financial accounting in the first place, because these are the foundation that lays into your trial balance, and from your trial balance, it goes into your final accounting process. So if the foundation, which is your ledger and your journal entry, is so whack and shallow that is not good at all, the foundation is so weak, trust me, the financial statement that you are going to be preparing will be as good as poor. Even if it's already filled before you even started. So that is how it looks. So this is where it all begins. This is where the concentration all begins, where you are preparing your ledger and you are preparing your journal entries as well. So what are your journal entries overview? What do you mean by journal entries overview? Journal entries for every business, and they make a trade. For every transaction made, you must record it in your books. For every transaction, so that you don't forget. There will always be a reason why you should always be keeping book records of your transaction. So this is where the journal entry comes in, because if times goes on, you are involving a volume of transaction and you are thinking your head capacity can take it. Trust me, the printed pen is more reliable than the brain that carries so many things on his head. So once you write it down, trust me, you can't forget it as long as you are keeping proper records of it. So there are a few steps. She's in the office. Sorry about that. So there are a few steps to this. There are a few steps you have to follow when accounting for a transaction. The first step is to record transaction in a journal. Use your journal to identify transactions. Your journal gives you the running list of business transactions. Each line in a journal is known as journal entry. What does that mean? Is that before you can actually prepare your full ledger itself, for every little transaction you are having, you need to prepare a journal entry. You need to know that this is the account we are recording, we are debiting, this is the account that we are crediting. Until then that is when you can prepare your ledger. And once you can prepare your ledger, it moves straight to your trial balance and your final account is ready. But trust me, if you can understand this process, then you are good to go. You are good to go. But you should just understand what to debit and what to credit. Each line in a journal is known as a journal entry, and each journal entry provides a specific information about a transaction, including the date of the transaction, the description note, the account name, and the amount. So what does that tell us is that for every transaction you have, there must be 4 details in your journal that you need to note. That is, the one is the date that the transaction was held, the description, what is the purpose of the transaction? Was it sales of goods in cash? Was it purchase of goods on credit? We need to understand what the transaction is all about. Then the account name, what are the accounts involved? Which one are we debiting? Which one are we crediting? And what amount are we even talking about in this whole transaction? For every transaction, there's always be money, because it's money we are actually talking about when it comes to accounting in the first place. So we need to understand that your date, the description, your account name, and the amount. Until then, every other thing that you are doing is wrong. So if you can give these 4 details, trust me, even when you forget about the transaction and you look at your book, it pop up immediately and you understand that, oh, this is what we are talking about. Journal entry also use 5 main accounts and sub accounts to stay organized. Yes, remember the 5 main of accounts. We have the assets, we have the liability, we have the journal, we have the expense, we have the revenue. And the sub accounts are just the examples of this account itself. And journal entry uses debit and credit as well. When recording journal entry, make sure your debit and and credit balance. So what are the codes to this journal entry in the first place? Debit and credit affect 5 main accounts differently. Some accounts are increased by debits, while others are increased by credits. Use the chart below, look at the chart below, and you will understand. Remember when I said to you that most of the transactions you see on your asset and your expense are always on the debit side. So for every other transaction that you are seeing on the credit side of your assets or the credit side of your expense, decreasing the value of the asset or expense. For example, you have 5 naira on your debit side of your assets records, and you have 3 naira on the credit side of your assets. Therefore, it's telling us that your asset has reduced to 2 naira because the difference between your debit side, which is 5, and your credit side, which is 3, is 2. So if you look at this way, that liability, equity, and expense can increase by putting figures on the credit side and decrease by putting figures on the debit side. It is as simple as easy like that. Let's look at some example to buttress our point. Journal entries may sound confusing in the first place, yes, but as time goes on, you will understand it because it's just the simplest of all transactions when it comes to recording of transaction. Okay, for example, you paid rent in your business location. Your rent is 1,500 naira per month. Your journal entry would look like this. Although the transaction does not give us a date. So assuming it gives us a date, we'll be having dates in this side of the column. We have our dates. We have our accounts. What accounts are we even talking about? So which accounts are involved? Paid rent per month. And you paid in cash. You can't pay anything on credit. You paid. It said you paid. So you can either pay it via your ATM or bank, or you can either pay through your cash. So in this case, we are assuming that this person paid through cash. So one is receiving and one is actually giving out. This is obvious that you are paying cash. So cash is the one that is giving out. So you are giving cash out. Cash is the one that is releasing himself. And who is receiving? The expense, because rent is actually an example of an expense. So this is another where the tax is for you. You need to be able to identify all these type of accounts. Let's say you want to know where salary falls. Is salary an example of an asset, or is salary an example of an expense? So these are things you need to understand that, okay, salary is an example of an expense, but anything that involves day-to-day running of the business that you are incurring is an expense. For example, your transportation, your advertisements, your selling and distributive expenses, and so on and so forth. Your rent, as you say, your NEPA bill, electricity bill, they are expense because it involves the daily running of the business. Without these things, there's no way the business can actually operate. However, what comprises of the example of your assets are like your furniture, like the chair that I'm sitting on, the building itself, the table, your laptop, your phones are example, because you don't often buy all these things on a daily basis, but these are work or tools that enhance the productivity of your business. So you need to be able to identify this example of accounting itself. This is where the tax really is. It's not the calculation, it's not any other issues. So we paid rent, that is where the note is. That is why we are having this transaction. Remember I said expense actually receive and cash actually give out. And that's where we are having 1,005 on the debit side and 1,005 on the credit side of your journal. Now, note on this place, look at the template, look at how it looks like. It is very easy to understand. Date, account, notes, debit, and credit, and put your transaction on it. This is a typical example of a journal account. Remember when I said your journal must balance? When we said your journal must balance, this is what we mean. You cannot be having 1.5 here and you're having 1,000 here. It means that you are understating a particular transaction, because what you are giving out to someone is what that person is actually collecting. So I cannot be giving you 1,500 and you are telling me that you collect 1,000. It's not possible. So that is why this have to balance. It's just need to balance. Your expense account increases with the debit your expense, like I said earlier, on account with 1,500 to show an increase in your rent expense, and your cash is an asset. Apparently, it's the one that is given out in this case. So it decrease your cash account, credit it to what? 1,500 naira. Remember, when you are crediting asset, it decreases the account. When you are debiting asset, it increases the account. Same thing with asset expense. Vice versa is the case when it comes to liability, income, and equity. Then, how do you now post your journals to your general ledger? Having said all this, for example, you need to post all of this transaction. You need to post it into your general ledger, because this is just a one transaction. You have another transaction that you prepare like this. You have another transaction that you prepare like this, and ledger will just come and combine all these transactions that you prepare separately together as one. Only then you now know what balances of each account that you have opened is. This is not that hard. It's very sweet and interesting if you just calm down and understand how accounting works. So how to post journals entry into general ledger. After you record your transaction in your journal, it's time to transfer them to your general ledger. To keep your books accurate, post every transaction from your journal to your general ledger. To keep your book accurate, you need to post every transaction. Don't omit one. Don't leave anything omitted, because that is when issues start rising, that your account will not balance, that you'll be having issues one or the other when it comes to your account. Use your ledger to classify and organize the transaction. When posting entries to the ledger, move each journal entries to an individual account. I don't know if that makes sense. Use your ledger to classify and organize transaction. When posting entries to the ledger, then move each journal entries to their individual's accounts. So when you're talking about expenses, so for every journals that you have opened expenses for, then you just need to move all those those entries into their individual account. And when it means individual account, you're talking about their individual ledger account. Okay, so let's move. Transfer the debit and credit amounts from your journals to the ledger account. Your journal entry acts like the set of instruction. When posting journal entries to your general ledger, do not change any information. For example, if you debit an account in journal entry, debit the same account in your ledger. Keep in mind that your general ledger lists all the transactions in a single account. This allows you to know the balances of each account. Like I said earlier, the purpose of the general ledger at the end of the day, or it compile all your journal lists into one transaction, and for us to just know the balances left for every account. So that's the purpose of the general ledger. But to find the balances, you need to do some math. After posting the entry to the ledger, you calculate the following. Asset and expense. For asset and expense account, subtract the total credits from the total debits. Now, it sounds like it's awkward because now you need to subtract the total credits from the total debits. So why can't we subtract the total debit from the total credit in this case? So these are the things we need to understand, that it is assumed in this place that for your asset and your expense account, your ledger, for example, that the debit side should be bigger, should be higher than your credit side. So that is why we are subtracting the total credit from the total debit. There's no room for us to be having a negative figure. But when we have a negative figure in accounting, it's called a loss. The same thing, vice versa, opposite direction is for liability, equity, and revenue account. Subtract your total debits from your total credits. Easy peasy. If you don't want to mess with your calculation yourself, consider investing in accounting software. But that is for people that are working, for people like us. But unfortunately for you, there's no accounting for software with Ican. So you have to use your calculator. Probably that is what you mean. You have to use your calculator to consider yourself lucky. Anyway, now these are the steps that you need to understand from your journal to your ledger. Create a journal entry. When you create a journal entry, remember how I explained to you how you create a journal entry. Remember those 4 key things: your date, your type of account, your description, and your amount. Make sure the debit and credit are equal. Remember, in your journal entries, move each journal entry to its individual account in the ledger. For example, you might have opened a lot of bank, or cash, or expense in your journal entry. But by the time you are moving them into your ledger, you are opening just a single bank account, and you are moving all the transactions where you have bank, you are moving it to the ledger, so that we will just know the balance of what we have left. Use the same debit and credit and do not change any information. Calculate account balances in your general ledger and easy peasy. How to post journal entries too. So let's look at an illustration here. Remember this transaction. Do you still remember this template rather? Date, description, debit, and credit. Perfect. So to keep your record accurate, you should post to the general ledger as you make transaction. At the end of each period, transfer journal entries into your ledger. Ledger entries are separated into different accounts, and the accounts are called T accounts. Organize your debit and credit for each account, as there is a T account for each category in your accounting journal. So let's look at this. We have deposits, we have 2,000, we have rent 1,500, we have deposit 1,000, deposit 3,000, inventory 1,000. Subtotal, if you have all this together, you have 6,000, you have 2,500. Now, the subtotal rule gives you details about the subtotal for your debits and your credits, because this is a checking asset account. Deduct the credit inside the credit from your debit to get your total balances. Why are ledger important? There are numbers of reasons why ledgers entry are so important. So important. Keeps you organized, make it easier to find transaction, compartmentalize your transaction. Like you can easily look at the bank account, you can easily see the cash account, you can easily see the expense account of your transaction. It lets you see the big picture of the company in financial health. It lets you know because you can see the balances of almost all the transaction. Then it lets you know that, okay, oh, this is going well, this is perfect. We are not having a negative balances everywhere, all over the places. And it shows you patterns in income and expense. Posting entry to general ledger helps you catch accounting mistake in your records. Catching mistake early on helps you steer and clear of a bigger problem down the road. Remember, did I give you the line of where we are heading to from all this thing? So for every transaction, remember you keep a bookkeeping, and the bookkeeping is called journal, where you have your dates, you have your type of account, you have your description, and you have your amount for every single transaction. Okay, look at it this way. Now, for every those single separate transaction that they are having those things, then you are now transferring them into one big journal account for every line type of account. Now, we have transferred those transactions to our ledger. The purpose here is to get our balances. Now, by the time we determine all our balances and we have gotten it, what next? What's next from there? We prepare our trial balance. Now, it's that balance from our ledger, trial balance. It is that balances from our ledger we pick up to trial balance account. Remember, it's a trial balance. So your trial balance also must balance. That is why we are trying it if it's going to balance in the first place. So it needs to balance. So in other words, what do I mean by it needs to balance? The credit side must be equal to the debit side. And from there, once your debit side is equal to your credit side and everything is balanced, guess what? You are preparing your comprehensive income statement, where you have the trading account and profit or loss account to determine your profits. And after you determine your profits or your loss, depending on the situation of the country, then you move straight to your balance sheet statement of financial position. And after you've moved straight to your statement of financial position, you've gotten it, your balance sheet must balance in the first place, where you have your assets on one side and your liability and capital on the other side. And everything is balanced. Then you prepare your cash flow statement. And that's it. Are we having enough cash? How liquid are we? And that is it. So you can imagine where you are going to. And if the foundation that I was saying earlier on spoiled, you can't get there. So it's down the line that we need to understand it. So that's why we need to understand that if you can just keep records of each transaction, compile on the transaction using general ledger, then you are easy to go. You are good to go. Okay, let's look at this question. Sorry. Mr. Roberts commenced business on 4th July 2011 with a capital of 100,000 in cash. On the same date, he opened a bank account with ADCB and deposited 20,000 naira. During the month of January 2011, the following transaction took place. January 1, bought goods for cash. These are two things that are involved. I told you for every transaction, there are always two things involved, and those are the two things you are going to be debiting and you're crediting. So we can see we have the date, January 1. We have the description, bought goods for cash. and it is left to your horse to determine which two accounts were affected, and we have the amounts. Those 4 things. Key things. Sold goods to Steve Cole on credit, 38,000 naira on January 2. On January 15, sold goods for cash, 9,000 naira. Steve Cole paid. Remember that Steve Cole that is owing us 38,000, paid 35,000. Stationery bills paid by check on 22. Telephone bill by check, by cash. Bill paid rent by cash, 22,000 naira. Paid salary by cash, 3,000 naira. Withdrew cash for personal use, 5,000 naira. Record the journal entries and then post them to journals. It's as simple as that. So what are the journal entries we are preparing? How many transactions do we have? We have 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So we have 10 transactions that took place. And if it is 10 transactions, so we are going to have 10 journals entry. We are going to be having 10 journals entry. And from there, we can now transfer it to our general. Can we move on? Okay. So remember, the first one was that he started a business with how much? With 100,000 naira. But how did he? But how did he do the 100,000 naira? He said he transferred 20,000 naira to bank. Then he should be having an amount of 80,000 naira cash with him, making 100,000 naira, right? So how can we prepare this transaction? See, January 1, we debit our cash on hand, 80,000 naira. We debit our bank, 20,000 naira, and we credit our capital. Another word for capital in this case is called equity. You know, capital is the money you use to start up a business. Do you understand? So this is it right here. Note that the most important accounting question you won't have to account for is cash on hand and bank in separate accounts. In most questions, we combine all these things into bank. Yeah. So in most of the time, because cash and bank are always most of the same thing, so they can just call it cash and bank accounts. So we just put it in the same places. And the reason more of the reason why we have cash book itself, we have 2-column cash book and we have 3-column cash book itself, because we are still speaking of the same thing, especially this period where we are even into cashless society environment, whereby the money is in your bank is actually like it's in your pocket, you know, so you can easily transfer money at a go. So most of the time we just combine the cash and bank together. But for this case, we just, for your level, no. So we have to separate them, that cash on hand is 80,000 naira and the bank is how much? 20,000 naira. So all together is 100,000 naira on the credit side, which is what we use to start up the business. Journal is that simple and easy going. Okay, let's look at the other transaction. What does the other one tell us? It said bought goods for cash. So you bought goods and you pay cash. 2 accounts are involved in this place. What are the accounts that are involved? What you are buying, which is purchases, right? So you can either call them purchases or you can call it inventory. In this case, we are calling it inventory because it is goods and the goods you are selling in the first place. So we are calling it inventory. and you're paying cash. So which account is giving out? Cash. Who is receiving? The inventory. January 1. Remember that model. Remember that model. The date will be January 1. Description, bought goods for cash. And sorry, not this one now, not this one I wanted to show you. And the account. So we'll be having inventory, yeah? We'll be having cash here. The note will be bought goods on cash. Then the amount will be 70,000 naira here and 70,000 naira on the credit side. The date, January 1. Another transaction has come. Note that it is purchases. Yeah, I remember what I was telling you, that you can either use purchases, but then because it is goods they are buying, and it is said that but most likely the goods that they are buying is what they are also selling. So that is why we are using inventory. If you use purchases, you are not wrong. If you use inventory, you are not going to get another extra mark. It's just the same thing that you're going to be doing. But it just shows that you understand this better. So what does the other one tells us? Remember, for every line of transaction, what are we doing? We are opening a journal for them. We have not even combined it. We are just still opening a journal for each transaction. So sold goods to Steve Co. on credit. What does that make of Steve Co? Steve Co is our debtor. How can he buy goods on credit? It means that it's our debtor. So we already have a debtor in hand. So since we are selling the goods to Steve Co on credit for 38,000 naira, then what are the transactions we are opening in this case? You are debiting your debtors account. Sorry, it's no longer called debtors account, it's called trade receivables account. And we are selling sales for 38,000 naira. That is on January 2. The other transaction is that sold goods for cash. This time around, not on credit, for cash. So this we are getting our money back. So there's no point that you are saying somebody is owing us. So we are having cash on hand for 9,000 naira, and we are still selling for 9,000 naira on the credit side. So remember that Steve Co that was owing us 38,000 naira, now later came back to pay us 35,000 naira. This time around by check. So in other words, this money is not coming to our hand, but it's going to the bank. However, it is our bank, so it's our bank that is receiving the money. So we are going to debit our bank account with 35,000 naira. Remember who we are debiting initially when Steve Co bought goods on credit. So in here, we are going to be doing what? Be crediting the debtors account. Remember, 35,000. Stationery bill paid by check. So we bought stationery. Stationery is an expense. So you debit stationery account and you credit your bank that is giving out. Telephone bill is an expense. You debit telephone bill and you credit the cash that you are giving out. Paid rent by cash. You debit your rent because they are all expense and you credit your cash account. And paid salary by cash also. You debit your salary account because they're all expense and you credit your cash account. You see the way we are crediting cash account as if all our cash is going to finish. How much do we have left? So when on ground, there's no money on ground. And this person still have the guts to still withdraw cash for personal use. So we have to withdraw cash again for personal use of 5,000 naira. Okay. So these are all the ledger, journal entries that was passed for each transaction. Then let's see how the ledger looks like. Remember our cash on hand. Remember the cash on hand. Remember the 80,000 naira from the beginning and the 9,000 naira of sales that you made. They are all in the debit side. Why are they in the debit side? Because our journal said they are going to be in the debit side. This is the first one that is on the debit side, and this is the other one that is on the debit side. Can you see? This is our ledger. This is the debit side. This is the credit side. Note the difference between this your ledger and your journal account. This ledger on your journal account is not a T format. Look at it. It is just exactly like what a journal should be. A column section account. And we now have your debit next to your credit account. But look at your ledger. Your ledger has two sides. Sorry. Your ledger has two sides of the account. This is it. So you are bringing all those accounts together into one account. You are bringing all your ledger accounts into one account. So, and that is why we are having this side and your credit side. If you look at your purchase or inventory, your telephone expense, your rent, your drawings, they are all on the credit side of your account. Remember when I told you that at the end of your transaction, you will subtract your total amount of your credit side from your debit side when it comes to an asset. When it comes to an asset. Hold on. So, sorry about that. Anyway, the same thing also applies to your bank. The same thing also applies to your bank accounts. What have I done? I'll soon be leaving too. I'll soon be leaving. The next 5 minutes. So the same thing also applies to your capital account. Apologies for that. I'm at work actually. So we have a bank account also. All the account that we debited in our bank account, we have it here in our ledger, and the closing balance CF. This is it, 53,000. Remember, we have our capital of that 20,000. Remember the debtor that was owing us 35,000. Sorry, the debtors that was owing us 38,000 and they later paid us 35,000. This is it. This is our stationary account, and this is the balance brought forward. How am I getting my balance brought forward? Balance brought forward. This 85 is what is on the balance sheet here. The total of this 7,000 to this 5,000, subtract it from this 89,000 is what will give us 8,500 naira, which is our balance sheet. The same thing also applies to your control account, your sales, your stationery, your telephone expenses, and rents account. And that is it for how to transfer your journal entry to your what do you call it, your ledger account. So just note that we don't skip any transaction from all these places when you are transferring it to your what do they call it, your ledger account. For example, your rent expense of 2,000 naira and your credit expense of your cash in hand of 2,000 naira. This is your rent, your cash in hand, rent 2,000 naira, as you can see, 31st, and you go to your rent account, the corresponding entry of 2,000 naira. is there. So if you have any question, you can just let me know as we are rounding up the class. I'm once again sorry that we started a little bit late and we are closing a little bit early. Not because of this situation. So if you have any question, you can let me know. Or you can drop it on the chat box, or you can drop it on the WhatsApp group. If you have any question, just let me know. And if there is none, we call it a night. And we see you earlier time on Friday. And we continue from where we stop. Okay. Thank you. All the best.